Assalamualaikum warahmatullahi wabarakatuh. I'm Nur Izzatul Afida binti Ajudin, ID number 2023699258. Justification for FGV, Felda Global Venture Holdings Sdn Berhad is a leading player in the Malaysia plantation sector and one of the largest producer of crude palm oil globally. Okay, in our infographic, we provide insight into how financial market operate, including investment, risk management, and profitability strategy. Okay, the key insight into the measure is financial dynamic, aiding investor, stakeholder, and policy marker. We also exploring how FGV navigated post-pandemic disruption, reveal effective of the recovery measure that can serve as a blueprint for other business.
I'm Aminatul Haida binti Abdul Rahman, and I will present the background of FGV. Here we present key information about FGV's background, business sector, strength and weakness. FGV is a major player in a global palm oil industry, contributing significant to both global and Malaysia's CPO production. Since its listing in 2012, FGV has been focused on achieving strategic goals and creating value for its stakeholders. FGV's operations are diversified across several key sectors, including plantation, oil and fats, sugar, logistics and support, and consumer products. This division represent FGV's core business areas and contribute to the overall performance. FGV primary strength lies in its market leadership in the palm oil industry, being one of the largest CPO producers worldwide. The company's extensive land holdings provide a secure supply of raw materials, and opportunities for further growth. A key weakness for FGVs is the reliance on palm oil as its main source of revenue, which can make it vulnerable to market fluctuations and the parts.
Assalamualaikum warahmatullahi taala wabarakatuh. My name is Siti Salana binti Muhammad Zani. I am from NBO 3M class. So today I'll be presenting an analysis of the company's liquidity ratio for FGV company. So now we just focus on the current ratio and also the quick ratio. First of all, I will explain what is the current ratio is. So the current ratio is to measure the firm's ability to meet its short-term obligation using current asset. So based on the report as we have done from performance by year from 2019 to 2021, we observe a steady improvement, peaking at 1.22 times in 2021, reflecting strong liquidity. However, in 2022, the ratio slightly declined to 1.17, and in 2023, it dropped significantly to 0.57, signaling potential liquidity challenge. And then we go to the quick ratio. What is the quick ratio is? The quick ratio is a which assess the firm's ability to meet short-term obligation using more liquid assets. It shows a similar trend. So between the 2019 and also 2021, the ratio improved from 0.73 times to 0.82 times, so indicating better short-term management. However, in 2022, it declined to 0.72, and despite all slightly recovered to 0.78 in 2023, but it still remains below the ideal benchmark, which is 1.0. So overall, in summary, while the company for the FGV company showed that the strong liquidity performance in 2021, the sharp declines for both ratio is by 2023, meaning that they highlight a need improve short terms for the financial management.
For leverage ratio, based on the graph, okay, in 2019, the debit ratio was at 66 times, meaning the company assets were financed through a debit. This ratio indicated a moderate level of financial risk. Okay, by 2022, the debit ratio decreased to 64 times, and it's showing a slight improvement as the company reduced its debit relative, okay, in the total asset. For 2021, the trend continued with the ratio drop at the 60 times, okay, followed by 2022, dropped to 56 times, okay. This marking is a significant reduction in debit level. This ratio remained steady in 2023, which is a 56 time actually. So it's showing consistent in managing debit and maintaining a healthier financial position. Okay, based on the graph of the time interest earned, okay, in 2019, the debit result in a negative ratio of 71. Okay, this indicate that the company did not generate enough earning to cover its interim obligation. However, in 2022, EBIT improved to a ratio of 72. Okay, although the result remain below 1.0, it show a slightly recovery compared to 2019. Okay, but for 2021, the company achieved significant improvement with EBIT producing a ratio 3.30. This suggests that the company earned over 3 improvement. Okay, term interest obligation indicating stronger financial in health. Okay, in 2022, the ratio slightly declined to 3.09, reflecting stability but with a minor dip in the coverage. Finally, in 2023, EBIT fell again, leading to a ratio of 0.52. This marked a concerning drop, showing that company once again struggled to cover its interest costs.
This slide analyzes the company's activity ratio, specifically focusing on the average collection period and total asset turnover. Here, we examine how efficiently the company managed its receivable asset and assets over the past few years. Average collection period. The average collection period, the average number of days it takes from company to collect payment after a sale. In 2019, the company was highly efficient, collecting payment in just 5 days. However, this period significantly worsened in 2020 and drastically increased to 181 days in 2021. A notable improvement was seen in 2022 with the collection period decreasing to 13 days. However, it slightly increased again to 36 days in 2023. While the 2023 figure is not as good as 2022 or 2019, it is still a substantial improvement compared to the peak of 181 days in 2021. This fluctuation this fluctuation in the collection period could be due to various factors such as change in credit policies, economic condition, or customer payment behavior. Total asset turnover, or TATO. The total asset turnover ratio measures how efficiently a company uses its assets to generate revenue. A higher TATO indicate better As utilized in 2019, the total was low at 0.06, indicating inefficient asset use. It shows some improvement in 2020, 0.09, which is 0.09, and further improvement significantly in 2021, which is 0.14, reached a peak of 0.18 in 2022. However, the total decreased back to 0.09 in 2023, suggesting a decline in asset efficiency is this decline in tattoo in 2023 warrants further investigation to understand the underlying causes.
Hi, now let's take a look at the company profitability ratio, which is we will focus on the net profit margin and also the return on asset. So the first one, I will explain what it net profit margin is. Net profit margin is we will observe a fluctuating trend. So based on the report that we have done for 5 years, in 2019 the MPM was negative 0.03%, which is indicating a negative margin. It slightly improved to 0.08% in 2020, and then peaked at 0.44% in 2021, showing that the company's most profitability year. However, this declined to 0.38% in 2022 and further dropped significantly to 0.07% in 2023, signaling reduced profitability. Okay, so we're just moving forward to the return on asset. So what is the return on asset? Return on asset is this ratio to measure how efficiently the company to generate profit from its assets. Based on the report performance per year that we have done, in 2019, ROA stood at 0.02% but dropped to 0.01% in 2020. It rebounded to 0.07% in 2021, marking the strongest performance. However, it slightly decreased to 0.06% in 2022 and further dropped back to 0.01% in 2023. This is highlighting declining asset efficiency. So, what can I conclude? This is for FGV company, while 2021 marked as a peak in the both profitability ratios, the subsequent years show a very downward trend and indicating challenges in maintaining profit margin and asset efficiency. Thank you.
Okay, for conclusion, the company significantly reduced the debt level. Okay, strength is financial position and lower financial risk. Okay, but for 2022 and 2021 show improved liquidity due to strong cash flow and efficient working capital management. But some period explain a decline in liquidity. For 2021 saw a sharp decline due to a slower customer payment or less effective credit management. It's caused a potential cash flow challenge actually. And while the company achieved progress in debit reduction and had a stronger year in 2021, it faced a challenge in a sustaining financial performance, highlighting area for improvement in liquidity, receivable management, and operation efficiency.
Okay, last but not least, this slide outlines key recommendations derived from our financial analysis of FGV. While the company has successfully reduced its debt level, several areas require focused attention. Firstly, improving cash flow is crucial. This can be achieved by enhancing inventory turnover and reducing DSO through better coordination between sales and finance, and revisiting credit policies to manage receivable more effectively. Secondly, while asset utilized improve until 2022, with sharp decline in tattoo in 2023 necessitate a true review of operation efficiency across all areas. Finally, FGV should focus on improved liquidity and profitability for boosting EBIT and implementing effective cost management and involving strategies. By addressing areas, FGV can strengthen its financial health, mitigate risk, and position itself for sustainable growth in the future.